Let's talk about one of the most powerful and honestly most controversial economic tools ever invented, quantitative easing. You've probably heard the term, but it's one of those things that can feel like a total mystery. So what is it, and how does it actually work? Let's break it down.
To really get QE, you have to picture this. The world economy is in an absolute freefall. And the one big red button central banks always push to save the day, well, what happens when it just stops working?
So here's how we're going to tackle this. First, we'll look at the crisis that forced this radical policy into existence. Then we'll get into the nuts and bolts of how QE actually works. We'll explore what it was supposed to do and then dig into the controversial side effects. After that, we'll see why trying to reverse it is so darn hard, and we'll wrap up by connecting all of this to the birth of Bitcoin.
All right, so our story really kicks off with a massive crisis that pushed the world's financial leaders into totally new and, frankly, scary territory. For decades, the playbook for fighting a recession was super simple. If the economy starts to tank, the central bank cuts interest rates. The idea is that this makes it cheaper for you to get a mortgage or for a business to get a loan. That encourages everyone to spend and invest, and hopefully that jumpstarts the whole economic engine again.
But the 2008 financial crisis, well, that wasn't your average recession. It was a complete meltdown. So central banks, like the Fed in the US, did what they always do. They started slashing interest rates. But this time, they cut them all the way down to zero. And the problem was, the economy was still in really, really bad shape.
They had hit a wall. Economists call this the zero lower bound. You can't really cut interest rates below zero, right? Their main tool was completely tapped out, but the crisis was still raging. They needed something totally new, something unconventional.
So this left them with a huge problem. How do you juice the economy when your number one tool is officially broken? Well, the answer was a radical and pretty risky experiment called quantitative easing, or QE for short.
Okay, so what is QE, really? At its heart, it's a way for a central bank to pump money directly into the financial system. So instead of just fiddling with interest rates, the central bank itself jumps into the market and becomes this massive buyer of stuff like government bonds.
So here's how it goes down, in 3 basic steps. First, and this is the wild part, the central bank basically creates new money out of thin air. It's really important to know, we're not talking about printing presses here. This is all happening electronically. Second, it uses that new digital cash to buy assets, mostly government bonds, from big commercial banks. And third, what's the result? Those commercial banks suddenly have their accounts flooded with cash. Just like that, their books look totally different.
Okay, so the central bank has just unleashed this tidal wave of cash into the banking system. But why? What was all that money actually supposed to do?
Well, the theory was that this huge cash injection would work its magic in 3 main ways. First, it was supposed to drag down borrowing costs for everyone. Second, it would nudge banks to take that new cash and invest it in other, maybe riskier things. And third, it would make people who owned assets, like stocks or a house, feel richer, which would hopefully make them go out and spend more.
Let's just connect those dots real quick. By buying up tons and tons of bonds, the central bank drives up their price, which has the effect of pushing down interest rates. That's what makes things like mortgages and business loans cheaper. And with all that new cash on hand, banks are pushed to go find better returns, maybe by lending it out or buying stocks. And as stock and real estate prices go up, homeowners and investors feel wealthier. And in theory, they open their wallets.
So that was the plan. But the real-world impact of pumping trillions of dollars into the financial system, well, that's where things get incredibly complicated and controversial. And this brings us to the absolute core criticism of QE. The whole point was to get money flowing in the real economy, to create jobs, raise wages, build factories. But is that where the money actually ended up?
Well, a lot of critics would give you a hard no. They argue that instead of flowing to Main Street, all that cash pretty much stayed locked inside the financial system. And what it did was cause a huge run-up in the prices of assets like stocks and real estate. This created a major disconnect, right? The stock market was booming, but the real economy was kind of just limping along. And this leads right into the second big criticism. It made wealth inequality way worse.
And this chart really gets to the heart of the problem. Financial assets, stocks, bonds, you name it, they aren't spread out evenly. Not even close. The wealthiest 10% of people own the vast majority of them. So if your main economic policy works by making those assets more valuable, you are, by definition, giving the biggest benefits to the people who are already the wealthiest. So, okay, you've pumped trillions of dollars into the system. It's been years. What happens when you decide it's time to take the money back out? Well, that is the terrifying challenge of something called quantitative tightening.
Quantitative tightening, or QT, is pretty much the exact mirror image of QE. It's QE in reverse. Instead of creating money to buy bonds, the central bank starts removing money. It can do this by actively selling the bonds it bought, or just by letting them expire and not replacing them. The effect is the opposite too. It pulls money out of the economy and pushes interest rates up.
Here's the catch. It's incredibly risky. The financial system has basically gotten used to, maybe even addicted to, all that cheap money from QE. The last big attempt to really reverse course, back between 2017 and 2019, had to be slammed to a halt because it started causing some serious stress fractures in the financial markets. The truth is, nobody really knows how to get out of this without breaking something.
Now, this whole era of absolutely unprecedented money creation didn't happen in a vacuum. In fact, the crisis and the response with QE directly inspired a radical and technological pushback.
The timing here is just everything. I mean, look at this. The original white paper for Bitcoin was published in October 2008, right at the absolute peak of the financial panic. And then the network itself went live just a few months later, in January 2009, at the exact moment governments were bailing out the very banks that caused the whole mess. That is not a coincidence.
For the people who created Bitcoin, and for its early supporters, policies like QE were the ultimate proof that the traditional financial system was fundamentally broken. They saw a system run by a handful of people that was prone to crisis and that relied on constantly creating more money, which slowly erodes everyone's savings. Bitcoin was designed to be the exact philosophical opposite, a system with no central boss, with rules that were totally transparent, and, this is key, with a hard, predictable, and finite supply. And if you need any more proof, this is it. This headline from a British newspaper talking about more bank bailouts was permanently coded into the very first block of the Bitcoin blockchain. It's like a digital fossil. It's a timestamp, a mission statement, and a permanent protest against the system that QE was created to save.
Which really leaves us with one final big question to think about. We now live in a world where these once extraordinary policies have become almost routine. But if your system needs these kinds of constant, extreme measures just to stay afloat, what does that tell you about the health and stability of the system itself?